Okay, let's dive into this. Welcome to the Explainer, everyone. Today, we are unpacking what might just be the single biggest risk to your portfolio in 2026. And here's the thing. The real threat isn't some loud, headline-grabbing event. It's not an AI bubble bursting overnight, and it's not a sudden geopolitical shift. It's actually something incredibly boring that you've likely never even heard of, unless, of course, you've ventured deep into the finance rabbit hole. Today, we're going to visualize the hidden forces quietly colliding right now to threaten markets, and we'll see exactly why the financial duct tape that's been holding everything together is starting to peel away. So ask yourself, have you been wondering why market conditions lately just feel kind of off? I mean, it's confusing, right? On one hand, we've got the Federal Reserve cutting rates, and bulls are buying up AI stocks like there's no tomorrow. But on the exact same token, something right beneath the surface feels incredibly unstable. Stocks will randomly freak out, and financial conditions still feel oddly tight. So what is actually going on here? Well, the media loves to talk about what's loud. The flashy headlines, the AI bubble, Jerome Powell's latest press conference, or the newest inflation print. Those topics get clicks. But the hidden reality? The actual financial duct tape quietly holding the entire global economy together for the past 30 years, it's Japanese government bonds. I know, it is arguably the most boring asset on Earth, and yet it's the exact place we need to look to understand this coming collision. Chapter 1, The Real Threat in 2026. To truly grasp why this year feels so perilous, we actually have to jump into a time machine and rewind all the way back to Tokyo in the early 1990s. Back in 1992, Japan's massive asset bubble burst. Real estate collapsed, equities plummeted, and Japan entered what's now known as the lost decades. We're talking about a multi-decade freeze characterized by absolutely zero real growth, no inflation, and stagnant wages. It was like their whole economy just hit the pause button. And faced with this unprecedented crisis, the Bank of Japan had to do what central banks do when they completely run out of options. They cut interest rates to zero, a massive flat 0%. And when that wasn't enough, they pushed them below zero. They introduced this extreme policy called yield curve control, basically supergluing interest rates to the floor to cap long-term bond yields. Now imagine being a Japanese pension fund manager or a life insurer with a billion-dollar portfolio, and your safe domestic government bonds are paying you absolutely nothing, literally zero. You have no choice. You are forced to look elsewhere to find yield. Which brings us to Chapter 2, Unplugging the Japanese Wi-Fi. Because what happens when an entire nation of investors staring down 0% domestic returns goes on a multi-decade global shopping spree? And this brilliantly illustrates the dynamic that unfolded. It's called the yen carry trade. Let's imagine an investor named Bob. Bob borrows money in Japan in yen at essentially 0% interest. He converts those yen into US dollars and then goes out and buys US treasuries yielding, say, 4%. He just pockets that spread. It's free money. Over 30 years, trillions of dollars flowed exactly this way, bleeding out into American tech stocks, real estate, emerging markets, you name it. Japan effectively became the world's silent landlord and its absolute cheapest source of liquidity. We've all basically been running on Japanese Wi-Fi. But then, in 2024, the fundamental assumption holding this whole massive trade together totally broke. For the first time in 17 years, Japan raised interest rates. And then they did it again. The market's reaction was violently fast. In a single day, the Japanese Nikkei plunged 12%, literally its worst drop since 1987, and the S&P 500 dropped 6%. The era of free money was officially, decisively over. You see, when Japanese yields rise, borrowing in yen becomes expensive. The math suddenly flips on its head, and when the math flips, the capital flows flip right along with it. This triggers a massive wave of repatriation. It's a silent exodus of capital flowing out of global markets and returning home to Japan. The world's most consistent buyer of US debt is suddenly taking a massive step back, and that reliable global ATM is shutting down. The legendary investor Ray Dalio hit the nail on the head when diagnosing this. He said, "The bond market is the basis. It's the backbone of all markets. It determines what all asset returns are going to be across the globe. At the end of the day, supply and demand in the bond market dictate everything. If Japan, a traditionally massive buyer, leaves the market, we are staring down a massive supply and demand imbalance." Chapter 3, The Nifty 50 Illusion. Now, we have to talk about the second massive force creating our 2026 collision, because this withdrawal of Japanese liquidity is happening at the absolute worst possible moment for the US stock market. Now, what's really interesting about this slide is just how dangerously top-heavy we've become. The sheer concentration of capital right now is staggering. Just 7 companies, the Magnificent Seven, now make up roughly 35% of the entire S&P 500's market cap. And because of the passive investing feedback loop where money just automatically flows into index funds and gets shoved into the biggest companies, it artificially drags the entire market higher. We think we have a diversified index, but quietly it's turned into a highly concentrated, incredibly risky bet. In the valuations, they've completely detached from gravity. The overall S&P 500 is trading near 31 times earnings, which is almost double its historical average. But dig a little deeper and it gets even wilder. You've got Nvidia sitting at 47 times earnings, Tesla at 247 times, Datadog at over 430 times. Investors aren't looking at fundamentals anymore, they are literally pre-ordering hope. It's this comforting bedtime story we tell ourselves, that these one-decision stocks will just grow forever and ever, and that gravity somehow no longer applies to Wall Street. But here's the catch. We've heard this exact same bedtime story before. Let's look back at the Nifty 50 bubble. In the early 1970s, after a huge post-World War II bull run, investors fell head over heels for blue-chip, one-decision stocks. Companies like Coca-Cola, McDonald's, and Polaroid. The consensus was that these businesses were so dominant, you only ever had to buy them and never sell. The Nifty 50 ballooned to make up about 45% of the total market, trading at a jaw-dropping average of 42 times earnings. And then, 1973 arrived. The bubble popped, and it wasn't a gentle correction. The broader market crashed by 50%. The damage to those one-decision darlings was absolutely brutal. McDonald's fell over 70%, and Polaroid collapsed by more than 90%. And don't think it was a quick V-shaped bounce back either. It took 8 long, agonizing years, all the way to 1981, for the market to just crawl back to where it was. Investors were totally trapped in 8 years of financial purgatory. As Mark Twain famously said, history does not repeat itself, but it rhymes. Look, today's Magnificent Seven are undeniably incredible, innovative companies. But so were Xerox and Polaroid back in 1972. The companies have shinier special effects today, but the plot of the movie is exactly the same. We are staring at an intensely top-heavy market, pretending that valuations don't matter, at the exact moment a massive macroeconomic shift is underway. Chapter 4: The Great 2026 Collision. This is it. This is the terrifying moment where these two massive, undeniable forces smash into each other. A historically concentrated, overvalued U.S. stock market directly colliding with the multi-trillion-dollar withdrawal of Japanese liquidity. A lot of investors are sitting around thinking, well, the Federal Reserve will just cut rates and save the day, right? Not exactly. The Fed only controls the short lever, the overnight rates. But the long lever, the 10, 20, and 30-year Treasury yields, those are driven entirely by global supply and demand. If Japan is no longer there to absorb our massive, exploding trillion-dollar deficits, long-term yields have to stay elevated to attract new buyers. And that happens regardless of what Jerome Powell says at a press conference. So the crucial point is that this dynamic creates what we call a steepening yield curve. The Fed can cut those short-term rates all they want, but the long-term yields, the ones that actually matter, stay elevated. Why? Because the consistent demand from Japan simply isn't there anymore to soak up the colossal supply of U.S. debt we keep issuing. And let me be clear, this is definitely not just some nerdy bond market story. This is an everything story. It trickles down into every corner of the economy. When long-term yields stay elevated, analysts are forced to discount future cash flows at a higher rate, which means stock valuations compress, earnings multiples shrink. It also means your mortgage rates stay painfully high, choking off housing affordability, and corporate credit tightens up, slamming the brakes on business growth. The very foundation of how we value assets begins to crack. Chapter 5: Surviving Financial Purgatory. So what does this all mean for us? What should we realistically expect as this financial duct tape finally gives way? And how do we actually protect our portfolios? Well, the most likely outcome, and the one that almost nobody is positioned for right now, is what we can call the 2026 gray area. It's likely not going to be a spectacular AI-fueled melt-up to the moon, but it's also probably not a total overnight Armageddon. Instead, it's going to be a long, choppy, sideways grind. It's a frustrating, difficult market where every rally feels totally fake, every dip feels like the beginning of the end, and capital simply rotates from sector to sector while the underlying foundation resets itself. This is exactly the kind of market where impatience will absolutely destroy your wealth. The reality is, the actual threats in the markets aren't the loud ones trending on Twitter or making front-page news. They are the ones hiding in plain sight. It's time to stop chasing the next Pokemon pack AI stock hoping for a quick flip and start paying serious attention to the plumbing of the global system. Make sure you hit that subscribe button to keep tracking these fundamental global shifts with us, and leave you with this one vital question. Will your portfolio actually survive when the financial duct tape fully gives way?